The safest dividend stocks to buy in June 2020. Welcome in, guys. My name is Manico. Today we're going to be discussing a few of the safest dividend stocks that still have growth in them for the long term. So I hope you enjoy. If you do, don't forget to smash that like button down below and let's get right into the video. Alright, so stock number one is Microsoft, ticker symbol MSFT. And basically, Microsoft is trading around $185 currently and pays out a 51-cent dividend per quarter. So that gives them a dividend yield of about 1.1% with a low payout ratio of only 32%, meaning they only pay out 32% of their profits into dividends. That means there's a lot of room for that dividend to grow over time, and it can even double and they'll have no problem paying it. Microsoft has also been increasing this dividend for the past 10 years consecutively. And obviously, Microsoft is one of the largest companies in the world. They have a market cap of $1.4 trillion. And they have a phenomenal balance sheet, meaning they can withstand anything that the economy throws their way and they'll be fine overall. They have about 138 billion in cash and short-term investments and only 65 billion in short and long-term debt, meaning they have that huge buffer for them to withstand anything the economy tries to throw their way, and they'll be fine for the long term. So not only this, but they actually made $40 billion in net income in 2019. That's huge, and they only paid $14 billion in dividends, meaning that they have huge potential to expand this dividend over time. So not only is this a safe dividend, but it's a safe growing dividend. So I believe Microsoft is a great addition to any portfolio in terms of the dividend and the growth, and to have both is even better. Alright, so stock number two is Visa, ticker symbol V. Now, I'm pretty sure you all know Visa. It's a payment processing company. So their shares actually trade around $196 currently, and they pay 30-cent dividend per quarter, giving them a dividend yield of 0.61%, which is extremely low. However, their payout ratio is under 20%. So by only paying out 20% of their profits, they have huge potential to double, triple, or even quadruple this number without having a problem. Visa has also increased its dividend for the past 11 years. So they bring in about $12 billion in net income every single year, and they only pay out about $2 billion in dividends, meaning that they have huge room to expand this dividend over time, and that's a great sign for dividend stock. Visa is also benefiting huge from everything that's going on with the pandemic in the world right now. Since a lot of people don't want to touch cash, and a lot of businesses aren't even accepting cash, credit cards and debit cards have become the primary payment method. And who benefits the most out of all this is Visa, because they take a small fee of every transaction, and this goes straight to their bottom line because their expenses are minimal. So the more people pay for items with credit cards, which I believe is the future, the more money Visa makes, and the more money goes to their bottom line, and the more money they can pay out in dividends. So Visa is a very solid company at its core and has huge growth potential, making this a safe dividend pick for the long term. Okay, so stock number three is Home Depot, ticker symbol HD. So Home Depot is a hardware store. Their shares currently trade for about $250 a share, and they pay out a $1.50 dividend per quarter, giving them a dividend yield of about 2.5%. With a payout ratio of about 55%, this makes the dividend extremely sustainable, and they will be able to grow it over time as profits also increase. So as you may know, Home Depot is also an indirect beneficiary of everything that's going on in the world right now. They were actually deemed an essential service, meaning they were able to leave their retail locations open for the public. This means that people that were staying home and wanted to renovate their homes could go to Home Depot to get their supplies. And when they went to Home Depot, obviously Home Depot made more profits, and this gives them a lot more money to pay out in dividends. Another big positive for hardware stores like Home Depot is that Amazon hasn't been able to penetrate this market. Many people that are renovating their homes would rather see the products in person rather than buying them online and having them ship over to their houses, because if the products aren't what they thought it would be, then they would have to ship it back and have to wait even longer for the actual product to arrive. So in this way, they actually just go to the store, get what they need, and go back home, and they have already what they need. Instead, on Amazon, especially with the delays that have been happening recently with the online shopping, because so many people are online shopping, the delays have been tremendous. And instead of waiting 2-3 weeks to get their supplies, they'd rather go to Home Depot to get them right away. So the stock is actually up 65% since the March 20th lows. And this is probably because of them being deemed an essential service and because so many people are renovating their homes right now. So a lot of this good news might already be priced into the stock, but it still might have potential for the long term. So it's a very interesting stock to look at, and it's still a very safe dividend company to invest in because the dividend isn't going anywhere, because it's extremely sustainable with the amounts of profits they're bringing in. So for the next two stocks, I wanted to look at some slower growing companies that pay out a larger dividend yield. So not everyone wants to have a growth dividend stock. Some people just want that big dividend yield and live off that. So let's get right into it. So for stock number 4, we have Procter&Gamble, ticker symbol PG. So Procter&Gamble shares are currently trading for around $118 a share, and they pay out a dividend of about 79 cents per quarter. This gives them a dividend yield of about 2.7%. They do have a payout ratio of about 67%, which is a little on the high end, but as long as it's under that 75% threshold, I'm okay with that, because you always want to try to be below that 75% mark, because as soon as you start getting over that, the companies are basically betting that their earnings will remain stable. And if ever their earnings drop a little bit, they might have to start cutting that dividend. So Procter&Gamble owns so many huge companies that they are here to stay. Companies like Tide, Crest, Pampers, Pantene, Head & Shoulders, all these huge brands, they own them. So with brands like these, Procter&Gamble isn't going anywhere anytime soon. Their stock will probably continue growing slightly every single year, and their dividend is 2.7%, which is very respectable considering the interest rate environment that we are in currently. So this is a great, safe dividend stock for the long term. Okay, and the last stock is PepsiCo, ticker PEP. So PepsiCo is another huge conglomerate of a company that is known for paying a relatively high dividend and being a safe dividend investment for any dividend investing portfolio. So PepsiCo shares are trading around $132 currently, and they pay a dividend of just over $1.02 per quarter, and that gives them a dividend yield of just over 3%. They do have a high payout ratio at 74%, which just made that cutoff of 75%, meaning that they pay out 74% of their profits in dividends. But considering the huge brands they have, they probably won't be dipping huge in earnings anytime soon, because even in a recession, people always need to use these kind of products. So this is another huge conglomerate that isn't going anywhere. They own brands like Gatorade, Pepsi, Quaker, Lay's, all these huge companies, Doritos. These aren't products that people usually don't buy during recessions. They are food products, so people usually consume them no matter how the economy is doing overall. So just like P&G, PepsiCo is here to stay, and they pay a great dividend for the long term, and it's a great addition to any dividend portfolio. So I really hope you enjoyed the video. If you did, don't forget to leave a like down below. Let me know in the comment section your favorite dividend stock to invest in. Don't forget to click that subscribe button if you want to see more videos like this in the future, and click that notification bell so YouTube notifies you when I post new videos. But apart from that, thank you for watching, and I'll see you in my next video.